I think there's actually going to be a revolution in optimization on products based on tax ideas, location, and all sorts of fun things that fly in the face of conventional wisdom.
This podcast is for advisor use only and not to be distributed to the public. The Wealth Consulting Group is an SEC registered investment advisor, and the opinions voiced and contents in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful.
Welcome to the Bull of Wall Street. This is episode number 38. I'm joined by my co-host, Talley Leger and Paisley Nardini, and we are super fortunate and honored to have on with us today Meb Faber. Meb, how's it going?
What's up, y'all?
So we were just chatting about the surf instruction that you do for advisors.
You know, for those listening coming down to Huntington Beach for Future Proof, we would love to welcome you into the ocean. I promise it's for everybody. You can have wetsuits if you want, big foam boards. We do a free surf party lesson in the morning, and then that night we celebrate over some beers and Monday Night Football. I think this year's Vikings, Bears, maybe. So both of them free. Tabs on me and friends. So please join.
Nice. So Matt,
there's a lot of great market analogies in there for surfing. It's very humbling, just like the markets. You know, you just get pummeled. Particularly if it's a bunch of advisors from like Ohio, South Dakota, places where there's not an ocean. It's a good experience. We take lots of photos. That's my main role as photographer. So I get a lot of embarrassing photos of everyone wiping out.
That's
awesome.
I tried surfing once. I live in Orange County, by the way, so I have no excuse, but I tried surfing once. I washed ashore and like a 5-year-old pointed and laughed at me. And I was like, you know what? There's other things I'm good at. Like, it does not need to be surfing. So I commend anyone, especially those traveling in from the Midwest for Future Proof, that join you on that surf trip. That's
please
cool.
do, everyone, all invited.
Well, if I'm going to Future Proof, I would, but I'm not going this year, but maybe next time. So sadly, I went to school in Hawaii and I did not learn to surf. So, poor man surfing, body surfing, whatever you want to call that, or, body boarding, but maybe someday I'll put that on the bucket list. So Meb, you have your own podcast and you're a CIO for your firm, and you also have some of your ETFs. I mean, and you've got quite the background. Tell us about your journey. Tell us about how you got started and kind of where you're going.
Oh, where we're going, man, that's a great question. Who knows? It's for like most of us, it's been a windy path, not deliberate and intentional at the time. I love to shake my head at these college graduates today. I feel like every old person, and say, but look back at me when I was that age, had no idea what I wanted to be, what I was going to do. But I cut my teeth in my favorite bubble. It feels a lot of rhymes and similarity today. The meme stalkers of stonkers of the last few years, trading GameStop and American Eagle and AMC and who knows what else. We love as professionals to look down on those crazy people trading 0-day options and everything out there. And, that was probably me, late 90s. I was a biomedical engineering student, and in my spare time was trading the CMGIs and Lucents and pets.com of my generation. So not too dissimilar. And then, you get a nice fat bear market, it cleans out and teaches a lot of lessons. It's like my favorite investing quote. Every investment makes you richer or wiser, but never both. And so I got a lot of wisdom in my old age now. Made all the mistakes that kind of created the path of, for me at least, moving towards being a quant, or at least rules-based, systematic type of investor. which fits my personality on very long time horizons. I don't want to check the markets all day long and think about intraday stuff. I want to think in terms of years and decades
Right.
even. So long, windy path, but we started Cambria. I don't look that old, guys. But 20 years, I think next year is going to be our 20-year anniversary. So yeah, and that's the best quote we give anyone in our world is you just survived. Doesn't matter how much alpha you generate. Doesn't matter you beat the market. All these 5 stars, billions of dollars. Just you're still in the game. I think is the biggest compliment you can give
Yeah, but
give
I think
anybody.
it's the surfing and the beer that's keeping you young, right?
I agree with you, and we'll definitely get all y'all out. Tomorrow you're only going to be one day older. It's not going to get easier, I promise you. But surfing you can do your whole life. There's I see a bunch of 80 plus year olds out there all the time. So
You said something earlier about college graduates, man. In this environment, given the advent of AI, I would not want to be a new graduate coming into this marketplace and this kind of soft labor market. And I've completely changed my tune. Jim and I, we kind of complain about the need and want for more support and analysts. And now I feel like I don't need it because I got 5 AI analysts at my fingertips now, and they're free.
I got 2 points to make on that. One is I hear you, and we've had a lot of fun. So we actually coded up a custom GPT based on all my writings, all my podcasts, books, white papers, blog posts, Twitter, and you can ask it questions, and it's not 100% me, but it's like 80%. You can ask it portfolio questions, be like, here's my portfolio. Can you contrast this, write the pros and cons? How would you switch? And I had an old friend sent me the recommendations. I was like, that's pretty good. Sounds like something I would say.
Exactly.
On the flip side, we had a bunch of interns this summer and they were fantastic. So you never know. I mean, things will switch. It's like, Josh Brown talks about when the whole robo-advisory phase was, it felt like, every advisor is like, oh my God, we're going to go out of business. We're going to be disrupted by this thing. And he's like, look, everyone in this world incorporates technology. Like in late 90s, everyone started using email, and then, email didn't disrupt the advisor, right? You just start using email. And so I think it'll just shift, but certainly for those that go for full ostrich, which a lot of people do in our world, and just say, look, I'm just going to kind of ride this out 10 years, retire. I don't have to worry about it. But I think for the longer time horizon, it's changing pretty quick.
Can I ask you a question about that while we're on the topic?
There's nothing you can't ask me a question about.
I love it.
Everything is full game.
Be careful.
Keep it family friendly, Talley.
Of course. We don't drink beer. It's pineapple juice only here. But so I was going to ask you about the role of technology, including AI, because we were just talking about it. Our audience here is mainly geared towards financial advisors, and you hit on it, Meb. So maybe you could kind of bring that out a little bit. What kind of role do you see tech like AI playing in the present and the future of financial advice, and how can advisors kind of pivot and effectively integrate this stuff, these tools, into their practices?
I think this applies to like every career. As you look out on the horizon, you say, how do I not get totally disrupted? I mean, it's a good thing. At the beginning of the 19th century, like most of us were farmers, right? And most of us are not farming. It's hard work. It's stinky. I come from a farming family, and I know it's none of the young people are doing it, right? And so you look at a lot of the careers. No one's making buggy whips or anything anymore, and so that's natural. Like that's the creative disruption of markets, and specifically to the advisor and asset management profession. This is the fattest industry in the entire industries of all the sectors and industries. Asset management and in general financial advisory, the profit margins are like it's like a third, right? Like it's just obscene. So if there's anything that's at risk of disruption, it's us. And you've seen that in the asset management world with flows to the low cost funds, which is amazing. It started with Bogle and others 50 years ago, and that's saved investors trillions and trillions of dollars. It's amazing. And so, but that'll continue. So I think all of us need to look and say, hey, what's our true value add? And we've said this for a long time, even back to the early days of the robo-advisors, to say, look, the big, huge value add for most advisors isn't necessarily always like the asset management side. I heard a great quote the other day that got my brain spinning. And I think this is from the Rational Reminder podcast, where one of the fellows said, hey, look, investing has largely been solved. And you start to debate that and think about that in your head a little bit. And, maybe not so much at the periphery, but the core tenets of it: low cost, be mindful of taxes, don't do really stupid things. So where are all the value added parts for an advisor? Behavioral, Vanguard puts out these studies: behavioral coaching, tax optimization, estate planning, insurance, keeping the future generations on path, education, all of this, not getting caught up in fraud. We did a podcast the other day with a guy in Italy, and he said, Meb, do you mind if we translate this into Italian? I said, sure, of course. But he translated into Italian with my voice. So it sounds like me speaking Italian, which is, I barely speak English. And so it's like a kind of an amazing setup. So obviously things are changing quickly. And I think for everyone, it's like, need to be honest and say, look, what is my value add? Where do I really bring, meaningful benefit to these clients in their life? And can I justify that fee? And I think that's, that evolves over time. Plenty of opportunity I think it's one of the most future-proof professions, but you have to be mindful.
Yeah, maybe a question I would have just on the back of a comment you made around kind of the shift towards passive, and less so about the active versus passive debate. I'm more interested in kind of delving into the topic of systematic. And I know that's kind of near and dear to your heart. How do you see that trend shifting away from maybe more discretionary into more kind of the rules-based systematic approach to active risk? Like, do you think that starts to play or continues to play a bigger role? Or do you think there's still room for kind of more of the discretionary fundamental active management?
Let me qualify this by saying I'm often wrong. So I'll look at certain ETFs or funds a launch and I'll be like, that is the dumbest idea I've ever seen. It's why in the world would anyone invest in this? And it raises like $5 billion. So, clearly there's a product market fit for certain people that want certain exposures. And if people want to gamble, hey, look, there's now 0-day options, go on. You can trade you could always trade pink sheet stocks. You could trade on and on, go to the casino with all sorts of sports betting, prediction markets, who knows? Anyway, but it's also the best time ever to be an investor. There's limitless choice. You can buy the global market portfolio and get exposure to tens of thousands of securities, stocks, bonds, all across the world. You look up some of these Vanguard portfolio holdings and you're like bonds from Kazakhstan and stocks from Thailand. I mean, and you get it for like 5 basis points. You include short lending. The portfolio is free, right? So in some cases, you're getting paid to own it. Amazing. Best time ever. And I would have said this for the last 5-10 years. That's kind of the base case. That's table stakes. And so for people to sort of, hey, why would I pay 50 basis points, 75, 100, 150? The average mutual fund is still over 1 percentage point. It doesn't mean they're not. It doesn't mean that it's not a value. Now, asset weighted, it's lower and it's moving in the right direction. But the table stakes are amazing. However, you look at sort of where's the innovation coming, what's next. In systematic, the passive active has been lost on me. It's more, is it rules-based, which most people would say is passive indexed, or is it discretionary? And traditionally and historically, that meant the discretionary and active meant high fee. But that's not the case anymore. So we manage soon to be 19, 20 ETFs, and all of them are cheaper than the category average, and they're all active. In some cases, the active funds are the cheapest fund in the category, so cheaper than all the passive funds. So the kind of labels have lost a little bit of meaning. But going back to Bogle, who I think is on the Mount Rushmore of investors, educators, product providers, he said the conflict of interest in the industry is not active passive, it's high fee, low fee. Morningstar just came out with their annual mind the gap studies, and almost universally, it's the one takeaway for predicting mutual fund ETF performance is you cannot consistently invest in these high fee tax inefficient funds. Like that is like just almost guaranteed negative alpha, but everyone gets seduced into this. And so I think there's actually going to be a revolution in optimization on products based on tax ideas, location, and all sorts of fun things that fly in the face of conventional wisdom. And we've got a few of those that I think are super interesting. And we often say fee and tax alpha is a lot easier than investment alpha. Investment alpha is quite a bit harder.
So maybe go ahead, Talley.
Oh, well, I was just going to cheat this one in here because you were kind of getting into active versus passive. Given that rising share of active, how do you compete as an active manager in this environment? Is systematic the answer? Is that the way to do it?
I can only answer for us, and there's tens of thousands of funds, and we try to only launch funds that don't exist or we think we can do much better or much cheaper. And that's a pretty lofty goal. Say, hey, you think you're going to be better than everyone else out there who's funded. Some of these companies have trillions of dollars of assets, unlimited resources. Like, come on, what are you thinking? But we also only try to launch funds where we publish a fair amount of academic research, or there's a fair amount of academic practitioner research already. But it also has to be something I want to invest my own money into. The average mutual fund manager, half don't invest a single dollar in their funds, which is crazy to me, right? And this goes back to the old concept of a lot of product providers just chuck everything against the wall in hopes that someone will invest and it sticks, right? But they wouldn't put their own money into it. Are you crazy? So it has to be something we want to put our money to. And so if you look at a lot of the ideas and you go back in history, you say, wow, that's crazy. Look, I'm biased. It's hard to argue with some of these ideas and logically, but it's also surprising to me still that they haven't caught on more. And we could get into any of these examples. Shareholder yield is an obvious one for us, but we only thought we'd ever launch a couple of funds, and here we are 20 funds later. And so we keep coming up with these screwy ideas that, in many cases, the world still hasn't come around to our way of thinking. So maybe they never will.
So maybe on that note around kind of innovative, unique strategies that don't already exist, and you've done quite a bit of work around the 351, especially as it relates to the importance of optimizing for, after-tax returns. I think that's still an area that's a bit opaque for a lot of people. I think at this point, a lot of people have heard of 351, but they still don't fully understand how to utilize it or how it could be beneficial for them. Would you mind just giving a 30-second elevator pitch on what it is and then how you guys at Cambria are playing into that?
Paisley, I think you're too kind. I think no one has heard of 351. I think that the percentage of financial advisors, I think it's 99% don't know what that means. And the 1% has somehow stumbled across our podcast or something we've done in the media.
There'll be another 1% after people listen to this podcast.
We're chipping away.
Chipping away.
I haven't met a single VC or founder or anyone that's ever knows what this is. And that's a shame. And so we're trying to educate the world one podcast at a time. But, so the massive revolution that happened when ETFs started trading over 30 years ago was that it's a superior tax structure than mutual funds. So SPY, had you bought it in the late 90s and you've never sold it, that capital, it's not paying off capital gains each year, whereas mutual funds do. And in many cases, mutual funds, you could buy a mutual fund, it'd be down on the year, and then they pay a 20% capital gains distribution. What an absolute kick in the pants. What a terrible situation. And yet it happens. And Morningstar puts this out every year. They do a list of kind of the worst offenders. And last year is there's some funds that are paying out 40% capital gains, which is just super painful. And ETFs kind of figured out this structure, and then the world has very quickly, we like to say ETFs are eating the asset management industry. So it's not just that they're cheaper, It's also, they don't have a lot of the traditional plumbing conflicts. They don't have front end, back end loads. They're not charging you 12B1 fees. But the big one is they defer the capital gains through the creation redemption. So I feel like everyone knows that now. However, we've had this romping, stomping bull market. We're sitting here at all-time highs. We'll ignore valuation for a second because we think this is probably up there with the most expensive markets in history. But it's been amazing times. Like, pat yourself on the back, drink some champagne, celebrate. Take the rest of the summer off. This is year 15 bull market. And this has only happened a few times in history where markets have compounded at 15% a year for a decade, 15 years. We like to joke that they all have names too. We're writing a book on the history of stock markets back to the 1600s, but for the last 125 years in the US, this has really only happened in the roaring 20s, nifty 50s, internet bubble, and then whatever we're calling this. The point I'm trying to make here is that if you invested back in 2009, or you just stayed the course, you're sitting on a 10 bagger, 10 times your money in the stock market. In the NASDAQ, I think it's 15 or 20 times. So there's a lot of people that have a lot of gains. And so they hear this and they say, well, Meb, no duh. We understand that we got all these gains, and we understand that the market's crazy expensive, but I can't sell it. Taxman's going to kill me. And we mentioned how important taxes are, but also I think it's important not to let the tax, kind of tail wag the dog. And so there's been a part of the tax code called 351 that's been around for like 100 years, but it's talking about how people come together to form a company and contributing property. So if you're starting a new farm or a new venture, and you donate the barn and I bring the seed and someone else brings the tractor, like, you shouldn't have to pay taxes on that contribution. And so this has been around forever. However, with sort of the rollout of the ETF rule in 2019, you've all of a sudden had this sort of perfect marriage of the ability to put those two together. So what does that mean? Sorry, long-winded intro, guys. I told you gotta narrow me down here. So you can basically contribute stocks or ETFs to the seeding of a new ETF and get a diversified ETF back in return, and it's not a taxable event. Now, this doesn't wash your taxes. That would be illegal. It does defer your taxes. And so this gives people the ability, if you got the Mag 7 or you got a bunch of Qs or you got a bunch of stuff that you just don't want, to say, hey, look, I want to contribute this, get a diversified ETF back in exchange, and be able to manage, hopefully my portfolio better or in a way that is more thoughtful. Sorry, that was a long-winded intro. It can get a lot more specific, but we started rolling these out last December. We kind of do one once a quarter. We did one in March. We got one coming up in September, another one in December. The only real kind of big innovation that Cambria has done, a lot of people, there's been over 100 of these, but traditionally it's either a mutual fund converting to ETF, so think dimensional or DFA, or it's an asset manager that's picking up all their hedge fund or their separate accounts and turning it into an ETF. We said there's no reason this shouldn't be available to everyone, not just Goldman's clients or something. So, let's do this open enrollment to where, any advisor could contribute for their clients' portfolios and get the ETF in return. So the custodians and the plumbing is getting better and better, and these are getting kind of bigger and a lot more transparent and clear, but that's kind of where we are.
What are some of the examples? I'm thinking about like the fund that you guys brought to market in March of this year. Like, what type of advisors or clients were coming to you? What types of stock positions were they holding? How many individuals had to seed that ETF?
So I think it'll surprise no one what traditional contributions often are. You get a lot of people that come to us. There's been one tool available for advisors for a long time called the Exchange Fund, and Eaton Vance, others have been doing this for 50 plus years. The challenge with the Exchange Fund is traditionally it can be expensive, or traditionally you got to hold it for 7 years. And so, people may or may not want to do that. And then you get back whatever people contributed. The nice thing about the 351 is you can kind of come up with all sorts of different ETF ideas for the final portfolio. So A year ago, we said, look, this is new. We don't pretend to know what people are going to want. So we had 2 funds filed already. So we're going to lay out 4 funds for 2025. And I'm including the one last December. The first one will be long only stocks, but a value quality approach. The second one will be a diversified global allocation. The first one ticker was tax. Second one is ENDW for endowment style, an aggressive allocation fund. The third one in September is going to be a global stock portfolio. And then the last one in December will be another US large cap equal weight portfolio. I said, I don't pretend to know what people want, but here's the kind of buffet. Because if it was me and I was getting out of, say, the Mag 7, not surprisingly, got a lot of NVIDIA out there, $4 trillion company, you're probably not going to want more US tech stocks, right? You're probably going to want to diversify. That having been said, the feedback we did get from a lot of advisors was, Meb, I've already got to explain to all my clients what like 351 is. I also don't want to necessarily explain to them your crazy ideas. So can you just give us sort of beta? And that's kind of the September and December funds. They're a little more, 25 basis points, long only stocks, top 500 market cap companies. I can't for the life of me launch a market cap US stock at this point in the cycle. I just can't do it. But we said we'll do equal weight because that'll kind of break the market cap link and be lower cost. So, and then we'll kind of roll out a 2026 onboarding, probably again, once a quarter, various funds, different enrollment. You can only contribute 351s on the seed. And I got to mention 2 important points. First one, top holding can't be above 25%. So the regulators in their wisdom said, look, we don't want people doing this as a tax dodge. We don't want people to do this. You have to contribute a diversified portfolio. Second is top 5 positions can't be over 50%. Takeaway from that is you basically need 12 stocks or more, or ETFs are pass through. So you could contribute theoretically 100% SPY to this portfolio because it looks through the individual holdings. Sorry, that was a lot of taxes for the summertime, guys.
There was a lull. I thought everybody's screens closed at once.
Yeah,
but I guess that happens. I had a question for you. This is a perfect group because I'm not a product guy, and you just talked about a whole bunch of product. So I caught one of your recent posts, Meb, and your complaint resonated about the challenge in marketing a 0% income fund as an efficient taxable strategy. And I guess it boils down to the average investor's kind of misunderstanding of passive income and how it actually works better in a tax deferred account. Can you kind of walk us through that logic, that post that you threw up recently? And I think advisors would probably get a lot out of it.
So first, you're asking me to bore everyone with taxes, and then now you're asking me to offend everyone with talk of the most sacred cow in all of investing. There's nothing that is probably more anti-consensus than what I'm about to say, which is, first of all, for the long history of investing, and I feel like most professionals understand this, but I would say a minority of individuals do, which is to achieve that historical magic, and I'm rounding up, 10% stock market return, you have to reinvest your dividends. Like, you're not allowed to go spend them, people. And also, dividends are not just some magical, it's not like bonds where you're getting a coupon payment, right? If you have a dividend payment, it reduces the price of the stock. There's not some magical free lunch. This isn't an allowance. So all the people that have these fantasies of sitting on a beach, drinking pina coladas, and just letting their sweet dividend income checks, passive income roll in, we like to remind them that you need to reinvest those dividends to get that total return. And then if you think about it, so look, I'm going to ignore the people who are in retirement. I want to spend that stuff. I'm not trying to get the full equity market return. I actually want the income. That's a tiny minority. For the people that are actually preservation growth, I'm reinvesting. Theoretically, if you're in a taxable account, the last thing you want if you live in a high tax state like I do, like Paisley does, last thing you want is dividends, right? Because you get the dividend, you pay a tax on it, and then you just go reinvest it. So we wrote this paper. It's got to be like a decade ago. No one read it. I think it's like 15 people read it. They're all my family. And so I wrote this paper that's basically, I can't say proves, but demonstrated. There's very little in the academic literature about this. That if you did an approach, theoretically, if you could match the returns of the S&P, but with no dividends in a taxable account, by definition, by logic, by math, the one that doesn't distribute the dividends should compound at a higher rate after tax. Sure. That shouldn't be that controversial. However, try to market a low, no dividend fund to investors. Like, forget about it. Like, what a stupid idea. We did it. And that fund's like one of our smallest funds. This is tax. It's like $30 million. However, the world is starting to wake up. So innovative providers out there, Simplify obviously does a lot of derivatives and interesting ideas. Our buddies at Alpha Architect, they did a really interesting box spread. So, hey, how can you get fixed income but without the income? Mm-hmm. And people say, why would you want that? Well, it's the same thing. It's like, I want the asset class exposure, but total returns and not the income. And that fund's raised $7 billion. So I think I'm inept at marketing. I need a better way to convey this. It's like the old death insurance, people calling it life insurance. Like all of a sudden people want it then. So my no income need to come up with a better phrase for it. But theoretically, if you're a taxable investor, you actually don't want dividend income. And that's a that's a hard pill, I think, for a lot of people to swallow. It feels wrong.
Feels like the people just need re-education on that because, their father, their grandfather, told them you want a company that pays dividends and they're going to grow their dividends. But like it makes 100% sense. 100% sense.
It's even more complicated by, look, if you take a step back and you say, what's the point of a company and what's the role of the CEO? And so our first book, Shareholder Yield, we wrote on this topic. It's free to download online. And, but basically the concept was, rarely in markets do people say, hey, look, this time is different. Something has structurally changed, but that happened in the US. And the big lever being stock buybacks. And there's a lot of myths around stock buybacks. I was getting into it with Mark Cuban last week. Again, he seems to have a really hard time with stock buybacks. A lot of people always assume they used to be illegal. That's never true. I got a couple books on my bookshelf back here from the 1970s talking about stock buybacks. Harvard did a case study on stock. I think it's like half the companies in the 1950s did stock buybacks. So never illegal. But what really started shifting in the 1980s and really 1990s was that companies started buying back a lot more stock. And this is another non-consensus but true axiom of markets. If a stock's trading an intrinsic value, and we'll ignore taxes for a second, stock buyback and a dividend are the exact same thing. And that fries people's brains. And then if you're Warren Buffett and you get it, he writes about stock buybacks like every single investor letter all the way back to the 1980s. He's got some amazing quotes from the 80s. He's like, look, if a company can buy back stock at 80 cents on the dollar, 60 cents on the dollar, they're crazy not to. It's the best use of cash. And so you've seen this huge shift where on average companies in the US buy back more shares than they pay out in dividends. And so if you ignore that, which is crazy, I think there's hundreds and hundreds of dividend funds out there, and so we call it shareholder yield, the combination of the two, but really in the US, it's mostly buybacks. So as the US, due to valuation, but also structural reasons, the dividend yield is ticking to nearly the lowest it's ever been. I think it's 1.2% now. And I think in 99, it hit the record at 1.1. So about as low as it's ever been. But in the US, a lot of that is buyback driven. I think we're going to cross a trillion this year in buybacks. And it's starting to shift around the world. You're seeing it happen in China, in Japan, in UK, other places as well.
I wrote about that recently myself, just at the start of the earnings season. I mean, all-time highs in buybacks. I think, what is it? The total income yield is something between 3% and 4% when you combine dividends and buybacks.
And historically, I think another myth is people always assume that it's just these nefarious megalomaniac CEOs that are buying back their stock at any price. And on average, throughout history, what you can see is that companies doing stock issuance trade at a valuation premium to the marketplace, and particularly the ones doing the big buybacks, so 5% of market cap or more, trade at big valuation discounts. But also, like, this is the same thing about talking about like value investing or really anything. Part of the benefits of when you're doing buybacks is what you're avoiding, and you're avoiding the serial share diluters and issuers, and particularly in California and the tech sector, you have these boards and CEOs that just issue an enormous amount of stock-based compensation. Think about like Snapchat. Some of these companies, it's 5-10% of their market cap per year. And so by avoiding those, which historically have just been dumpster fires as far as equity markets, that's also a benefit. Or as the late, great Charlie Munger used to say, he said, look for the cannibals, the companies eating themselves as far as share count. He tended to have a way with words. So I think the combination of the two is really interesting. On average, the stocks coming into our portfolio have a double-digit shareholder yield. In the US, that's majority buyback. In foreign developed and emerging, it tends to be closer to 50-50 with dividends and buybacks. But it also, one more thing, and this is what Mark Cuban gets wrong. All these people are talking about you need to tax buybacks more, make them illegal, all this stuff. You want unintended consequences. You take away the ability for a company to do buybacks and all of a sudden give the CEOs a bunch more money. What do you think they're magically going to do? You think they're going to magically pay all the employees more? No, they're going to buy. They're going to do a ton of M&A. They're going to name stadiums. They're going to buy more jets. Like the whole point of dividends and buybacks. Jason Zweig has an incredible article on this, where he says, look, 100 years ago, companies and governments used to require companies to pay out dividends and buybacks because it's only one of the only ways to keep them honest. Otherwise, people just spend it. It's like, I got money in my checking account. I'm going to go buy a new surfboard, go spend it on something. So I think that capital discipline is important.
Well, I know it's a pretty controversial topic for a bunch of different reasons, but my simple logic, and I agree with you, Meb, it's a good way for companies to reduce their share counts and give earnings per share mechanically a nice lift. And that's kind of one of the key driving forces of this bull market. And I agree with that one too, that we're currently in. And if you look at it, the time series since the late 1990s, when I started my career, the correlation coefficient between the growth in buybacks and earnings per share is 0.8. It's pretty robust. And that's not.
I like Buffett's approach, which is, you got to have a systematic way to say, hey, what is the valuation that I'm willing to buy back shares? And he's like 1.2 times book. He's like, I'll buy back shares when it gets down there. And so when COVID hit, everyone was waiting. I was like, oh, what's Buffett going to buy? What's Buffett going to buy? And I was like, no, he's going to buy a bunch of Berkshire, which is what he did. And then now, as markets are at all-time highs, Berkshire's gone up a bunch. He's just accumulating cash, right? So Professor Damodaran has a great framing. He said, you should call buybacks like tax-efficient dividends or flexible dividends, meaning for companies, they can choose to turn them on and off. Because historically, regular cash dividends tend to be a lot stickier, a lot lower volatility, because it's a signaling mechanism to markets. Hey, this company's healthy, this company's doing great. But here's a great reality check for most people. If you read an article and it has the word dividends, you should be able to sub out buybacks and it really not change the conclusion. And if you have an emotional reaction to either side, where you throw in buybacks or then throw in dividends, and it totally changes what the article says, then chances are you have an emotional attachment to one or the other that's probably not healthy.
So maybe just to kind of pick up on the topic of markets being at all-time highs and take maybe a shift into more current market commentary, like what are your thoughts as it relates to kind of where we are in the cycle, what it means for maybe US-centric investors? I know that a lot of us were thinking, market breadth coming back this year, more diversification. I think we have seen some of that, especially play out in the form of financials picking up, some of the industrials. But would just love to hear kind of your thoughts as it relates to U.S. centric investor portfolios.
You guys are just going down the road with things that are just going to trigger alerts for people. Look, my second least read paper was one called "Is investing at all-time highs a good idea?" No, it's a great idea. And historically, we do a lot of trend following, and investing near all-time highs is great. The problem is that, particularly with U.S. equities, which is sort of the premier asset class, right? 2/3 of world market cap wasn't always the case, right? The other countries have held the crown, UK, Japan, on and on. But on average, that means you should put 1/3 of your equity portfolio in the rest of the world, and no one does. Particularly in America, everyone invests in their home country. They put all their money in their own country, and that's fine most of the time. It's been incredible the last 15 years. Only thing you should have done 15 years ago is buy SPY and take a nap. But historically, the past 200 plus years, it's been a really foolish idea to concentrate in one country. And you can go back just to the beginning of the 20th century and say, was it a good idea to put all your money in Russia or China or UK, on and on, Greece, Argentina? Really, you can come up with any country diversifying globally as better risk-adjusted returns, but they can go through these long cycles. And we wrote a paper about a year and a half ago called "The Bear Market and Diversification," where we were saying that this exceptional period where U.S. stocks have just creamed everything is arguably the most impressive in history, and the only comparable period is post World War II in terms of years in a row outperforming an asset allocation portfolio. So for the advisors listening who did everything right and diversified and bought a bunch of diversifying assets and bonds and foreign stocks and real assets, well, congrats, your portfolio did great, did 8%. But guess what? Your neighbor did 15, just chilling out in SPY. And so it's arguably been the worst period in history. And a lot of those allocation portfolios underperformed like 8, 10, 12 years in a row. And so, but where does that lead us? If we know anything about history, these regimes can last longer than most of our careers. And we're at a place where U.S. stock market, we believe, is very expensive across any measure. Most of them are ticking off all-time high measures. Doesn't mean it has to crash, doesn't mean it have to go down. Like from where we are today in the 80s, Japan doubled. So things can certainly go nuttier to the upside. Mm-hmm. That having been said, I think we've reached the inflection point, and actually no one seems to be talking about it. I feel very alone here. And listeners, my largest fund's a U.S. stock fund, so I'm not just preaching my book. But foreign, particularly the value trade, the global deep value stocks this year are up 40%. I mean, U.S. is doing good. It's up 10%, great. But I think the inflection point where foreign is just absolutely ripping, foreign developed, foreign emerging are both up 20-ish something percent, 25, I don't even know. And so you've had this very long period of foreign and emerging underperformance. And some of that has to do with the dollar, right? This is one of the worst years ever for the U.S. dollar, first 7 months of the year. And that's always a contributor on both sides, tailwind and headwind. So we're hugely bullish, value, foreign, emerging. Within the U.S., we think value, quality, but also mid and small caps just cannot catch a break. I mean, they're flat on the year, hated, forgotten. At some point, we think those look very attractive, but also on the momentum and trend side, a lot of the foreign has the tailwinds, but so does gold, so does Bitcoin, and some of the real assets too. And that's an odd portfolio. But that's kind of where we think we are.
So you're kind of continuing to lean into that belief that diversification should favor investors. Part of it perhaps driven by kind of where we are from a valuation perspective, thinking about like longer term. I mean, we're so biased to look back over the last 10 or 15 years and extrapolate that over the next 50 to 100 years, when in actuality, there's many factors at play that will probably, kick that off its track. So I believe in diversification. I come from an asset allocation background as well, but I think looking in the rear view mirror is an easier exercise than having
Always,
the crystal
always.
ball.
But that's the thing, is that it's hard. Like, it's human nature, and we think a lot about this. The example I like to give that I think is, can relate, is we've had hundreds, thousands of conversations. We have over 150,000 investors, and so and now that we have near 20 funds, people reach out and say, "Meb, something's always doing great, something's always doing terrible." And so somebody will reach out and say, "Meb, I bought your fund and it's a dog. I've held it for 6 months, lost money. It's underperforming whatever the benchmark is." And we often do say, "Man, it can get a lot worse. Like, that's nothing. You haven't seen nothing yet. It could underperform for years in a row." And they're usually taken aback. And I say, "But that's the reality. Like, this, I think anything less than 10 years, and honestly, 15 to 20 is too short of a time to analyze not just a actively managed portfolio, but also an asset class." And people are like, "Oh my God, that's crazy. What am I supposed to do? I'm going to be 80. I'll be dead by then." I'll be like, "But just because that's how you want it to work doesn't mean how that works." And let me give you an example. I say, going back to the example, I say, people all the time, you say, "Mab, your fund's done amazing. Oh my God, you're so brilliant. It's outperformed. I'm going to keep buying it. I'm going to buy more." No one's ever said, "Oh my God, your fund's done way worse than expected. I'm going to buy more," right? They say, "I'm selling it." Like, you've done wrong. But the time frame on analyzing portfolios, we said earlier that dividends and passive income was like the most dearly held, sacred cow. But the most ironclad, I think, rule of investing that everyone accepts is sort of this equity premium, that stocks outperform bonds over time. I don't really know anyone that doesn't really believe that. I know a few that might kind of put an asterisk on it. But the point being is that everyone assumes that, like, that is going to happen in the next year or 2 years. And during COVID, stocks had the same returns as the long bond for 40 years, right? Not one or two, 40. And so, and in plenty of other countries, it's going to last 20, 40, 60, 80, right? So you have these periods where what people want to be true just isn't. And so I think diversifying is, you have to. I think it's crazy not to. Just because the future is uncertain, and we could go through so many examples in history of, people that didn't diversify into one market or one country. It's even funnier. The home country bias applies to sectors too. If you live in New York, you put most of your money in financials. Texas is energy. California is tech. And then also Vanguard put out a recent study that shows not only that, but your equity allocation depends on when you're born. So your formative experiences, if you live through certain market regimes, it greatly impacts your risk exposures. Anyway, long-winded.
A question. No, that's fine.
Yeah.
I love that.
Diversify. The bull market and diversification has begun. That's my takeaway.
So early in the year, I was kind of a lonely advocate of international stocks. So what you're saying resonates, and part of the thesis was U.S. dollar weakness, and that has, that's worked. That's one of the calls that has worked pretty nicely year to date. But I'm going to take the opposite side just for argument's sake. We'll play devil's advocate. I love that movie. That was a good movie. But why couldn't, like, we're talking about this massive share of tech relative to the S&P 500. Why couldn't it balloon to something that people operating today just couldn't wrap their arms around? And I'm thinking about this chart that I saw from Hartnett over at B of A that reminded us that the railroads actually captured 63% of the S&P, well, the equity market at that time, which is mind-boggling. So why couldn't this thing keep going? Like, why couldn't we have runway for another 2 or 3 years like we did in the mid to late 1990s?
It absolutely can. So this is the fun part about markets, right? So Professor Schiller, Nobel laureate Schiller now, he wrote a paper about the CAPE ratio, which is probably, now that we've ticked everyone off, would probably be the trilogy of triggering people. But looking at 10-year PE ratios, he does on the U.S. stock market, We're at, let's call it 38, 39 now. Highest ever was 99 at about 45. It's been as low as 5. But he also wrote a paper about sectors and a CAPE ratio. The tech stocks of our grandparents' generation were utilities, and the roaring 20s of 100 years ago, they hit a P ratio of 60. Imagine getting all hot and bothered about utilities, that's the AI of their time. And railroads, after the devastation of the Great Depression, they hit a CAPE ratio of 3 times earnings, right? So these shifts in sentiment, you often tell people, you're like, what's the difference between a PE ratio of 45 and a PE ratio of 5? It's just what's people's opinion of the place, what's going on. And that's an old Vonnegut line. And if you look at one of my favorite sentiment indicators, and it's really only useful at extremes, but the AAII survey, when I was celebrating December 99, it was the highest bullish sentiment ever, coinciding with the highest valuation ever, right? You would think it should be the opposite, but and then when was the lowest? Can't make it up. It was March 2009. So there's nothing stopping this from going up. And so we did a study in the last 125 years in equity markets in the US, and we just put it into 4 buckets. Is the market cheap, expensive, uptrend, downtrend? All quantitative, very simple rules. And not surprisingly, the best historical returning market were you in a cheap uptrend? Second best, though, is an expensive uptrend, which is where we are now, right? We're expensive and getting more expensive. Like, we could sit here a year, be chatting, and you say, God, man, can you believe it? We took out the highs in 99 and we're now sitting at a P ratio of 50. I say, well, that's crazy. But, China and India in 2007 were there. They were trading at P ratios of 50. And then Japan in the 80s hit almost 100. So nothing's stopping this going crazy. And there's been a lot of bubbles in history, canal bubble, railroad bubble, on and on. But every single one ends at some point. And usually it's a big stinking mess, where the drawdown 20, 40, 60, 80, 90%. Great Depression drawdown was 80%. So I'm not saying that has to happen, but traditionally very expensive markets have resulted in a much higher chance of drawdown and a much deeper drawdown the next 5 years. We've done these 10-year valuation metrics for all the countries in the world. And the good news is most of the rest of the world's totally reasonably priced at downright cheap. This was the first year since we've been doing this, and I don't even know how long, 10, 15 years, that the U.S., and we don't just track price earnings, it's price book, cash flow, on and on. The U.S. was the most expensive country in the world starting this year. But the good news is there's plenty of countries that are screaming cheap, and most of those, Poland, Greece, are up 50, 60, 70% this year.
So, Mep, I got a question about trend. You mentioned trend a couple times, and so we run some multi-factor models that are, we believe they're different than the other smart beta, products that are out there. We love momentum, value, quality, volatility as factors, but we throw in trend, and I feel like a lot of people don't understand that trend. Well, number one, it's different than momentum. And also it could be part of the risk management process. Can you, kind of share your thoughts about, why you use it and why are so many of these other smart beta I'll call them pure quant systematic. They're not active. They don't use it. And a lot of those have had really, really bad performance. Yeah. What do you think?
So both have a long and storied history. You go back 100 years and, you got Ben Graham talking about value investing. You got Charles Dow and others talking about trend following. And there's a storied history on both. We've kind of, going back to AI, we've kind of put together an AI trend following history documentary that should be out soon. We'll see. We'll see how it goes. But I think Buffett has certainly been the spokesperson of value, and there's been a lot of acolytes there that have done a great job talking about it. And we love value. But, the other half of my brain is trend, and there just hasn't been probably as many people out there. I don't want to say marketing, but really talking about it. There's certainly been plenty of people implementing it, and those people now own baseball teams like the Red Sox and on and on. But, trend following, I think, is harder. Value investing for a lot of people, if they do U.S. stocks, you don't look that different. You still are in the stock market, and I think it certainly, as Buffett says, like, inoculates people immediately. They get it. They get value. And trend, I think, is a little more abstract, but at its core, its definition, S&P 500 market cap weighting, Bogle, that's trend following. Like, it's just price of the stock, shares outstanding. That's it. It's a trend following index, and that's why investing in the broad stock market works, because you're guaranteed to own the winners and you own less of the losers. And then it's just kind of trend following. There's 1,000 different permutations and species, right? So you have things like managed futures, which tends to be a long short approach across every market in the world. We've owned CTA at Simplify, and think we still do. And there's a lot of different managed future style funds. They tend to look very different. And then there's kind of more plain vanilla, mellow, where you're doing sort of long flat, meaning you're in a market and you just, when it's going down, you just step aside. The thing is that, trend really only matters in a particular market when the market's moving. And usually, particularly on the downside, is when people think about it. So when the S&P is doing 15% a year, everybody's fat and happy. We're at the beach. We're on vacation. We're thinking about a timeshare in Cabo you're going to buy, or vacations to Europe. You're not thinking about diversifiers. You're not thinking about getting out or bear markets, but that's usually probably when it's most useful. But we're the biggest outlier in the country that I've ever spoken to on a diversified portfolio, meaning endowment, foundation, OCIO, sovereign wealth fund, that how much trend following could be as a part of the portfolio. And I think you could argue with a straight face up to half, which is what we do in our Trinity strategies. Most people, that gets capped at like 10%. If you're crazy, maybe 20. But historically, on paper, if you run the simulations, that's what the math points you to. It's hard for people to get comfortable with, because it feels like you're lonely. But I think that's the truth.
Yeah, I might just comment too, given trend following is near and dear to my heart, is thinking about like that key objective, which is diversification. It's helping smooth your portfolio volatility. But to your point, Meb, and you mentioned this at the onset of our conversation today, is when the rest of your portfolio is doing great, you don't want to see those diversifiers, right? So it's like you can't have your cake and eat it too all the time. And so reminding investors of that key objective, reminding investors that a diversifier is not always going to go up in one direction. It's there for another purpose in the portfolio. And just coming off of the second quarter of this year, which was one of the worst quarters for trend following going back to the late 90s, it's an easy time to then look at that, point at it on your quarterly report and say, like, get it out of the portfolio. And it tends to be these environments where it's the exact right time to add it to the portfolio. But again, I might be biased.
I'm going to read you guys my favorite quote of 2025. And I've been repeating this, so apologies if you've heard it, but the late, great Peter Bernstein, he says, I view diversification not only as a survival strategy, but also as an aggressive strategy, because the next windfall may come from a surprising place. And the nice thing about trend following traditionally is it kind of treats all markets the same, whether it's cocoa, the Japanese yen, US stocks, Tesla, Bitcoin, and you just never know. Like, you never know what is going to have that 10-bagger performance, or the thing that's going to go down 90%, whether it's cattle or lumber, on and on. And usually that often happens during times of geopolitical shakes. But that's most of the time. I feel like there's always something crazy going on in the world. So I think this year's a great example. Even with equity portfolios, U.S. is only a quarter of world GDP. And so all of a sudden you have these foreign face rippers. I think as people come back to school, sit back down at their desks from their vacation, say, oh my God, foreign stocks are up how much? You're going to start to see the sentiment shift. I haven't had financial advisors have the conversations yet, but I joke for 10 to 15 years, they'd sit down with clients and client be like, you joking me? Why do we have emerging markets ETF? Like, sell it. Like, it just underperforms. And then those people are going to forget, and they're going to sit back down with their advisor and this fall and be like, wait, why don't we own more emerging markets? Like, I thought I told you we need to, so I don't think any of those conversations have happened yet. But as the quarters tick on, I think we'll definitely see some more.
Speaking to emerging markets, actually, we in our Simplify risk-based models, we have EYLD, which is the sister strategy to your HAT. It's the shareholder yield for emerging market equities, and it's done really well just relative to passive.
I'll tell you the fun thing about that one. There's a couple things. Is this is a bottom-up approach, so we're not selecting countries, but we're letting kind of the data lead us. That fund historically, people always say MEB value has you don't get it. It's not going to do great because it avoids tech. And that's largely true in the US. EYLD in emerging markets, tech is one of the largest allocations. And historically, it's either the top one or two over the past cycle, which surprises people often. But if you think about it, foreign and emerging have just underperformed so much for so long. Most of these companies are just kind of bottom of the barrel. But also, particularly in emerging markets, this is true in the US too, but particularly true in emerging, because a lot of these companies are younger, is they're funding from share issuance, right? So they're needing to issue shares. The average stock in the US is a share issuer, but particularly in emerging markets, you see that behavior. So avoiding those companies, traditionally the companies that are returning 10% of their cash to investors through dividend buybacks are usually not the ones doing fraudulent or sketchy or stupid use of their money, right? It tends to be the ones that have a lot of cash flow in the first place, which in emerging markets tends to be a lot of tech, which is pretty cool.
Yeah, that's interesting.
So Matt, this has been super helpful. We appreciate your time. I don't know about Paisley or Talley. I got one last question. And
I'm ready for hour two. I'm just warming up, y'all.
This is a Joe Rogan podcast. We're going half day.
It cleared the schedule. Yeah.
So for me, like, we kind of talked about a lot of the worries that we have, risks that are out there. I would say, my final question, when you look out the next 5-10 years, for advisors, for investors, for the markets, what excites you the most?
So there's a couple of things. The first one is, we tell people, look, it's better to be Rip Van Winkle than Nostradamus. Like, we love spending all our time talking about the Fed, going on TV, talking about gold and Bitcoin and US stocks being expensive. But the reality is most of us will do some form of strategic allocation. And honestly, it'd be better after the show that we buy all these funds and put it on autopilot and just let them do their thing. That having been said, I think the vast majority of portfolios are way offsides. I think, and this is true all around the world. I think particularly in the US, investors don't have enough ex-US. They don't have enough real assets. We didn't get that much into that today, but things like REITs, TIPS, gold, Bitcoin, certain decades like the 1970s, for example, would have been a dumpster fire if you didn't have some significant real assets. And gold is popular now because, hey, it's at 3,500, but historically, unless you're Canadian, Australian, Chinese, or Indian, you don't put that much in. So things like that. What am I excited about? That's such a great question. I get excited about weird stuff. I'm going to give you something instead of excited. The foreign ex-US deep value, I think, is a 10-year trade. So I think that's going to be the rest of the 2020s. I'm certainly excited about a lot of AI stuff, but I'll give you a head scratcher. So answer your question slightly differently.
Sure.
I think the fixed income space to me is a head scratcher where the vast majority of risky bonds don't yield enough in the US. And I think you could see a scenario where the Fed cuts in September. I actually don't think they're going to cut. It's like 20-1 odds that they do, but I think they could very easily stand pat, which would surprise a lot of people, I think. But I think there's a scenario where the Fed cuts 1, 2, 3 times and the long end of the curve goes up, meaning that the yield curve steepens and all of a sudden 10-year yields 5, 6%. I think that would surprise a lot of people. But if you look at things like corporate bonds, they have some of the lowest yield spread ever. And if we know anything about markets, is that the chill times don't last. And so very high correlation with the VIX. At some point when something hits the fan, those will blow out again. But anyway, we got a book coming out. I don't think I've even told anybody about it other than y'all. So maybe this will be the news. I don't know when, but it's going to be a coffee table book, and it's going to be called Time Billionaires. And the concept is the last 400 years in stock markets, and kind of flipping through and all the lessons learned and crazy stuff that's happened and fun stories along the way. Yeah, might be 2026 because
good
it's supposed to be a summer sabbatical, but it's not.
Is that a reference to Time Bandits, Time Billionaires?
It's not. It's a reference to, I got really frustrated during sort of the whole meme stock, a lot of the youngins getting caught up in day trading, Robinhood and everything else, where kind of getting led through the casino to financial markets. And we don't teach financial literacy. So in schools in the US. And so trying to just teach this concept of this amazing gift, which is the ability to compound wealth across time. And time billionaire referring to someone like my son who's 8. Say, look, you got all this time ahead of you. If you can just start investing sooner than later, it's a magic formula.
Cool.
So that's so true. That's wonderful that you're doing that. Good to educate people.
I don't know if they'll listen, but at least I can say, like, I'll be the old man shaking my cane and be like, I told you so. But it's like the old chart of like all the crazy geopolitical events. It's like every year there's like 5 things that are horrific. And
yeah.
So, but that's been always true. And yet not 10%, like 8% a year, we cruise along.
Climb the wall of worry.
Yeah.
Well, Talley or Paisley, any final questions?
None for me. No, really appreciate the conversation. Great to see you, and bummed that I won't be at Future Proof to hang out.
Yeah, well, love to see all y'all in the real world. The invitation extends to all the listeners too. So come say hi.
Thanks, man.
Hers and his, three's company too. Come and dance on our floor. Take a step that is new.